Good afternoon. It's Jeffrey Christian of CPM Group. It's about 12:20 in the afternoon on Friday, May 10th here in New York. Precious metals prices have risen sharply today. They continue to trade pretty much in recent ranges, but they're at the high end of those ranges. Gold, as I speak, is around $2,375. It got up to about $2,385. Obviously, there's a lot of pressure and interest in seeing if it could push forward. Silver is about $28.65 right now. It touched 29 cents earlier in the morning. Platinum is $2 above 1,000, and palladium is $2 below 1,000. All of these have risen. It's very important to understand when you're saying, well, what happened here? Stock markets in the United States and Hong Kong overnight have risen sharply. Oil prices are up. The dollar is up. Copper is higher. Other base metals prices are higher. It's obviously a broad factor that is going on across markets. There were weak jobs report Thursday in the United States, and that fed into this wishful thinking that financial markets have had, that there'll be lower interest rates sooner than probably or reasonably likely to be expected. And that has sort of stimulated a lot of this. It's interesting because bond rates are actually up too, because the economy continues to show some pockets of strength. Prices are in this range. They're at the high end today. Could be at the low end tomorrow or Monday, because financial market participants keep vacillating, trying to decide whether they should believe or think that the economy is strong or it's weakening. There are some specific factors, tightness in some concentrate markets for base metals, Middle Eastern concerns, and other factors that are affecting oil or base metals and stuff like that. But generally speaking, what we've seen is this broad-based buying and selling of assets. And I'll run through a couple things about that now. Interest rates will only fall when the economy is significantly weaker than it is now. A lot of people keep hoping and praying for lower interest rates, and thinking that the Fed will lower interest rates. The Fed is only going to lower interest rates when they see significantly weaker economic conditions. So lower interest rates will not be a great sign of happy days are here to come. They'll be a sign of we're headed toward a recession. I'm in a kind of a bad mood, and I'll apologize. Not so much a bad mood, but a mean mood or a sad mood, I am just so tired of so much nonsense that goes around the markets. We've made the point repeatedly for 40 years. Yeah, actually, it goes back to 1980 with the monetarists and Milton Friedman saying that monetary policy is the end-all and be-all, and all you had to do is study monetary policy. And that was nonsense. It was at a time in the late 70s, early 80s, when a lot of economists dabbled in theories instead of empirical evidence. And we've always been empiricists as opposed to theoreticians. We pride ourselves on not believing in things, but rather paying attention to what's actually going on. We've always made the point that fiscal policy is more important than monetary policy. We've made it repeatedly recently because it's been true. And as you look at the state of the economy, you have to look at fiscal policy, which is contracting in many countries, including the United States, but is still extremely stimulative. And you have to look at conditions in the real economy, the real supply and demand of goods and services. That's what drives the economy. Monetary policy has always somewhat followed fiscal policy and real economic conditions, and that is still true. It's nothing new, and only the monetarist economists of decades gone by thought otherwise, and they were repeatedly proven wrong by actual economic conditions. It's not just economic theory that bothers me. There's just so much nonsense being sent around the world information-wise across things in society, politics, economics. It's just, it really can be very tiring. So excuse me if I sound a little bit bitter, but I am. Now, this is what's going on in the world. These green balls represent things that are positive for gold, which means almost universally negative for overall economic condition. They have grown in size. They've moved to the left or to the right, which means that they are more likely to affect the economy and thus gold and silver prices than they would otherwise be. And they've moved upward, which means that they're more likely to happen sooner rather than later. There are so many political, economic, and financial and social issues that are plaguing the world, not just the United States, not just North America, but the world and individual countries. And that is stimulating investment demand for gold and to a lesser extent silver as a safe haven, a portfolio diversifier, a way to protect oneself from hostile stock markets, hostile bond markets, volatile currency markets. There's a tremendous amount of confusion about why the dollar is strong, and you keep hearing people talking about the dollar is going to collapse. There's just so much nonsense out there. But part of that nonsense is driving investors into gold and silver. And part of the reality, these bubbles, also is driving investors into gold and silver. Gold prices, as I said, they've risen very sharply. They got up to $2,385 this morning. You know, they had gotten over $2,400 in April. That probably will be tested again. We're a little bit cautious in the near term, partly because we think that there are pockets of economic strength that the markets will from time to time pay attention to. You know, when the price got to $2,400 in the middle of April, there were guys, some of them from, have been talking about gold prices going to $10,000 since the 1960s and 1970s. A lot of them weren't born then. They've only gotten into being, quote, self-promoted experts, anointed experts in gold in the last 2 years or 3 years. Some of them have died and come back from the dead. When the price got to $2,400 a month ago, they were saying, oh, this is it. Once you get over $2,400, the next stop is $10,000. We were saying once you get over $2,400, you got profit taking setting in, and you've got seasonality setting in, and you have any number of central banks, investors, and fabricators who will buy less gold at higher prices, waiting for the price to come down. And that is probably where we're looking at right now. And it's something to pay attention to for the next several months. We still expect prices to rise and rise further in the final 4 months of this year and into 2025. But in the interim, prices could soften. This is gold price seasonality. And you can see gold prices tend to be the strongest in January, February, March. They tend to weaken in April and May. And then they get seasonally weaker in June, July, August, pick up again in September, October. We would not be surprised to see this kind of price pattern over the next several months. And as I said, we're looking at higher prices in the last 4 months of this year. The seasonality suggests that the prices could come off in November and December. We don't think that's going to happen this year. We think that November, December will be seeing stronger prices, similar to what we saw at the end of 2022. Investors continue to buy back. They have pulled back from the 40 million ounces they bought in 2020, but they have, over the next 3 years, they bought 25, 26, 24 million ounces. They're probably somewhere between, our projection earlier this year was maybe 28 million ounces. It could be higher. It could be 30 or 32 million ounces. Investors are buying more gold, and it's more investors, more types of investors in more parts of the world. It's not any single group of people. Gold and the dollar can, do, and presently are rising together. And you can look at the relationship between gold price changes and the dollar currency exchange rate changes. And you can say, oh, there's about a 32% correlation over time since gold and the dollar were floated one from the other in 1971. And you can look at it and you can say, okay, 32% of the time, that means 68% of the time they don't move in opposite directions. And you can break that down. And the interesting thing is, look at when they've moved together, both rising. 1976, 1977. That was a time when when the market consensus was that gold prices had a one-time adjustment to being floated and that the gold price was not going to rise again. And then the gold price started rising. We had high inflation. We had a lot of inflationary problems. We had a Federal Reserve that really wasn't as effective as it had been. It had been very effective under William McChesney Martin from 1950 to 1971. We went through kind of a weak period. We didn't get into the Volcker era until late 79. Gold and the dollar both rose in 76, 77. They both rose in 82, 83. And the correlation was very strong. And that's because when things are scary, people will turn to less risky assets and portfolio diversification. And that means the U.S. dollar, U.S. treasuries, and gold. Those are the three less risky assets that investors buy when things are scary. 2005, 2009 to 2009, again, both rising, although the correlation was a little bit less. So you shouldn't be surprised that gold and the dollar are rising together, because the idea that they only move in opposite directions is a myth. And there are billionaires who have lost hundreds of millions of dollars because they've said the only thing you need to know about gold is the dollar, because gold trades against the dollar. And yeah, we have an ex-client who has lost hundreds of millions of dollars because he said, everything else you say at CPM Group is meaningless. All you have to know is the dollar, gold trades against the dollar is going to collapse. And he's been saying that for at least 14, 15 years, and he's been wrong. Machines that learn, machines that don't learn. Similarly, higher interest rates, the correlation is zero. Changes in real interest rates versus changes in nominal rates versus changes in gold prices. If you look at it on a real basis, you've probably got about a negative 16% correlation. You can look at a scatter plot and you can see that it's distributed all over the place. It's not unusual to see gold prices and interest rates rising at the same time. And it takes real interest rates of greater 3% or more before you start seeing investors saying, why do I need to buy gold? I can lock in 3% real rates. We're nowhere near 3% real rates. We're at like 5.2 on a short on T-bills and 4.8 on 10-year notes with about 3.8% inflation. So we are nowhere near 3% or higher real rates, and we may not get there. Most economists don't expect that to happen. So you can see real rates strong. And again, they're strong compared to the zero interest rate policy from 2008 to 2021, but they're at the low end of the rates that you've seen from 1968 through 2008. You can see interest rates around 5%, maybe even a little bit higher for an extended period of time, and that's not necessarily going to turn off investment demand for gold. Turning to silver very briefly, we've seen we saw it touch $29 today. Again, you have to pay attention to where you're going to go. We're saying $29, $30 is probably the near-term peak, and we would expect the price to back off. We do expect the price to go higher later in the year and into 2025 and maybe even into 2026. similar to what we were saying in gold. And we've been saying this ad nauseum for way too long of a time. Other people will say once you break over 30, the next step is $100 or $3,000. Don't believe them. They've been wrong all along. Why would you believe them? Platinum prices, like as I said, they a little bit over 1,000 right now. That's probably a short-term, near-term cap for platinum prices. Our expectation is that they'll continue to trade between, say, $850 and $1,000, or maybe $1,050 over the next year or so. And palladium prices are even weaker, and they're about the same level, but they're a little bit. They've been testing going to a discount relative to platinum, but they're, as I said, right now about $4 below platinum prices. That is much weaker from a historical or recent historical perspective than with platinum. Platinum prices, you can see, were very high into 2014, and they've basically been trading in a broad sideways range. You could say $800, $1,200 for most of the last 9 years. Palladium prices, meanwhile, rose during much of that period of time into the early part of 2022 when Russia invaded Ukraine, and since that time it's come down. So that's where we are right now. Our expectations are that gold and silver could quiet a little bit, but we're seeing a tremendous volatility in what investors think and believe about the state of the economy. And that's going to keep gold and silver flopping back and forth. It will probably support platinum and palladium to some extent, although we find those less attractive as longer-term investments. Silver Yearbook will be released on May 23rd. We've rolled it back a little bit because of changes in our schedules and such. The report is just about done and probably will be done by early next week, but we're going to wait on the briefing because we have other logistical issues that we have to deal with. You can go to our website and buy the Gold Yearbook, which was released in March. You can pre-order the Silver Yearbook. You can pre-order the Platinum Yearbook, which will be released in July. You can send us an email at info@cpmgroup.com and tell us how you think we might be able to help you manage your exposure to precious metals and commodity prices. Thank you. Take care of yourself. Take care of those around you. Have a good weekend. Do something productive, do something enjoyable, and see if you can help the world in some way, because right now the world needs all of us working in a positive way to counter some of the negative activities that's going on. And be careful what you believe and listen to. There's a lot of nonsense being circulated on the internet and other press and media. It's a bad time for humanity. Take care.